specialist here at Quest, and I work in our marketing department and help to put on all of these events for you guys. So we are super excited to have Paul Williams with us here today from Multifamily Geeks. He is actually going to be talking about cap rates when you're investing into multifamily. So it's definitely a question that we hear all the time. What are the cap rates? How are they calculated? And, I'm actually excited to learn a little bit of info myself today about this. So before we get started, I do just have a couple of quick announcements for you guys. As always, please remember that Quest Trust Company does not give tax, legal, or investment advice. This presentation, as well as all of our other presentations here at Quest, are strictly for educational purposes only, but we are always here to help answer questions if you guys have them. We actually have a team of about 15 certified IRA specialists on our staff that are here to help walk you through any questions that you might have, whether it's about multifamily investing, rolling over your 401k, how to get started with an IRA. We are here to help walk you through the process, and we really pride ourselves on our great customer service and the ability to really make this whole thing make sense for you guys whenever you are looking to invest with a self-directed IRA. So this event is just one of many webinars that we host. Right now, all of our events are online due to COVID. We'll probably be starting up the in-person events just a little bit later this year, but be sure to check out all of our other events and webinars that we have going on right now. I do have Miss Sarah Shellum here online moderating with us today. Sarah is one of our IRA specialists out of our Dallas office. So if you guys have questions throughout the presentation, feel free to shoot her a chat and she can help you out. And she will also be posting some links to our upcoming events and further resources that we have for you guys. So just a quick preview of some of our upcoming events for the next week. Our next webinar will be this Saturday at 12 p.m. Central Time. This is our Self-Directed IRA Saturday series. And this weekend, we actually have Fred Moskowitz teaching about due diligence when investing into mortgage notes. So that'll be a great presentation. And next week, we have a class actually from our president, Nathan Long, talking about the top tips to keep your retirement on track in 2021. We also have our famous private money lending class next week, taught by Anne Marie, one of our executives here at Quest. And next Saturday, so a week from this Saturday, we are bringing back Tracy Rui. She is also a note expert, and she will be talking about small dollar IRA investing into partials of notes. So great topics, not only just today, but coming up for the rest of this month as well. We do have our full calendar posted on our website. You can see that under events, click on webinars. You can see all of our upcoming events right there. And you can also rewatch today's class as well as all of our other classes on Facebook and now on YouTube as well. So do us a favor when Sarah shares that YouTube link there in the chat, take a quick second and go subscribe to us on YouTube. We have a ton of new classes and videos that we post every single week. And last but not least, my personal favorite event that I have coming up next week is our virtual networking happy hour. So this is an event that we host twice a month on the first and third Wednesday. And it's basically an online Zoom meeting happy hour. We all have a beer or a glass of wine together, and everyone gets a chance to introduce themselves. This happy hour has been great. We started it up back in August, and it's really taken off. Last week, we had over 70 people, investors from across the US online with us. So come hang out. I know we're all missing the in-person events and that networking, but this virtual happy hour does help to supplement that just a little bit for you guys. So be sure to check out those links. We've got a ton of great resources for you. And be sure to reach out to us directly if you have any questions. So that's all I have for my quick announcements. I want to go ahead and pass the torch off to Paul from Multifamily Geeks. If you guys have questions throughout the presentation, be sure to post them in the Q&A box, and I will come back on at the end and we'll answer all of the questions that you guys ask during and after the presentation. So Paul, so great to have you here today. It's nice to see you again. It feels like it's been a while, even though it really hasn't been that long. And I'm excited to see what you brought for us today.
Thanks, Haley. I appreciate the opportunity, and I really like Quest. Our group really likes Quest. They didn't ask me to put any plugs in for them, but they are our custodians of our IRAs, and they've been a really good match for us. Really easy to work with, super knowledgeable staff. Their experts are truly experts, and we've thrown some difficult questions at them, and they always come back with an answer. They're super knowledgeable. If you're looking for an IRA group, I would say to look into Quest. So thank you for the opportunity to speak here. My name is Paul Williams. I'm with Multifamily Geeks. Multifamily Geeks is an apartment complex investor, syndicator, which means that we buy apartment complexes, large apartment complexes, generally 100 to 300 units. We improve the value. We buy it using investors' money, private investors' money, cash, IRA, whatever. Buy the apartment property, improve it, and then we turn around and sell it for a profit, and we share the returns or share the profits with the investors, the cash flow, and then at the end when we sell it. Right now we have 811 units. We've sold off about 1,200 units in the last 12, 16 months or so. And we're always on the hunt for more good deals. We actually have another one of our properties under contract to sell. So we're, trying to make it happen. And so we're always welcoming new relationships and things like that. We shoot for delivering returns of 16 to 20% to our investors that invest with us after any profit split. So that's who Multifamily Geeks is. I've been in real estate since 2001 in single family, small multifamily, large multifamily, land development, and I'm near Austin, Texas. So I've been to a lot of the Quest events. Okay, so I wanted to, I love talking about multifamily, but a question that I hear a lot at conferences and different events is people trying to figure out what cap rate is, trying to understand what the cap rate is, who sets it, why is it important, what does it mean? And sometimes the answers I've heard from panels or speakers leaves the audience more confused than they came. So before I talk, about multifamily, I just kind of wanted to hopefully be a help to you by explaining what cap rate is. And this is true whether it's multifamily, office, self-storage, other commercial, understanding the cap rate. Okay, so I've got a couple of slides here that I'll put up on the screen. And then after I talk about cap rates, I'll tell you a little bit about how multifamily is valued, how to maybe evaluate who to invest with, give you a quick case study. And then if you have questions, if you'll drop it in the chat box, Haley will get those over or ask those. And if you got more than that, we can always talk after. Okay. So there is the Multifamily Geeks here. Okay. So the cap rate is the net operating income divided by the purchase price. Net operating income is your income after expenses are paid. Essentially, it's your profit before any debt payments are made, any mortgage payments. So let's say that you have a property that is bringing in $200,000 a year. You have $100,000 a year of expenses. Then your net operating income, after all expenses are paid, excluding debt, then you have a net operating income of $100,000. Basically, you have $100,000 of profit before debt. So in this example, $100,000 net operating income on a $1 million property is a 10 cap. Let's take that a $2 million property, $100,000 net operating income or profit after expenses on a $2 million property would be a 5 cap. So cap rate does not include anything, does not consider debt at all. Let me move to the next slide here. So cap rate does not consider any debt, does not include or consider any leverage. So regardless of if you have a loan or not, that doesn't affect the cap rate. So if you buy this $1 million property with cash, and you're bringing in $100,000 after expenses, then that would be a 10 cap. If you have a mortgage on it and all of that's going to the mortgage payments, then it's still a 10 cap. Okay, so let me give you another example. Cap rates vary from region to region. It's kind of determined by what other properties are selling at. So if other properties are selling for a 5 cap, then your property is likely to sell, or the property you're looking at buying is likely to sell for a 5 cap also. Around the country, it varies depending on if you're in a big city or out in the country more. If you're in the city, core property, nice area, then you're going to be a lower cap. The more stability you have, and the nicer, the better the property, the lower the cap rate will be, because it's almost like your returns are adjusted for risk. If you're taking more risk, then you're going to get a higher cap rate. Now, just because you're at a higher cap rate doesn't mean you're making more money, because a lot of times the higher cap rate properties come with a lot more uncertainty and a lot more surprises. And so your what was supposed to be profit gets eaten up by surprise expenses. Okay, so back to the example. A lot of properties are kind of going for, in rough numbers, 5 to 6 cap currently. And you'll see some on the coast for, in a 4 cap, 3.5 cap, but kind of we're seeing a lot of 5 to 6 cap properties, and closer to 5 for the most part. But let's say that, back to our cap rate example, you buy this $1 million property and you're getting it financed, you're getting 3% financing. We're seeing that they're kind of edging up right now. So, we're seeing around 3%, sometimes as low as 2.75, sometimes, 3.5. So let's say that you buy a property at a 6 cap. Your interest rate is 3%. So, essentially half of your profit is going to pay debt payments. And then you're cash flowing that other 3%. Okay, so most people would say, well, 3% return is a terrible return. Why would I ever consider investing in commercial or apartments? Or why would I consider investing in anything that's going to just pay 3%? So the 3% that you're cash flowing is based on the total purchase price. If your purchase price was $1 million and you put $200,000 down to purchase this, and I'm using a lot of round numbers, so so as not to get too bogged down, then you're making $30,000 profit on the $1 million when you invested $200,000. So $30,000 profit on the $200,000 invested is actually 15% return. So without debt, maybe you get more cash flow, but your returns are lower. And so this is how we're able to deliver some higher returns to investors, is because we put debt on the property. With multifamily and some other commercial, we're able to get some very, very attractive debt terms. Sometimes an interest-only period. Sometimes it's fixed for a long time. So that's kind of cap rate. Hopefully, hopefully this is more enlightening than confusing. And if we were in person, I'd welcome some in-person questions, because I'm sure you guys have some. But hopefully that helps you understand cap rate. Cap rate is just the net operating income, the profit before any debt, divided by the purchase price. $1 million property, 6 cap, you're getting a 6% return on your money, $60,000, and then you pay debt payments from that. So hopefully, I'm not sure if I did a good job explaining, but hopefully that helps you understand. Okay, now I understand what cap rates are. And the cap rates are set by, as I mentioned earlier, what other properties are going for. Interest rates affects it. Consumer confidence, things like that can affect it. Okay, so there's all about cap rates. Okay, now multifamily, you know what? I forgot to talk about our core values. Okay, so there are 5 core values. They're team player, just means open, honest, transparent, humbly confident. It just means no arrogance, no entitlement. Third is do what you say, be realistic, but be reliable. Fourthly, do what is right for everyone involved and continually growing, open to the idea we could learn something that would change our perspective. We're human, not perfect, but this is what we strive for every day. And this is what we use to drive our daily decisions. Okay, so there's contact info. There's one of our properties that's under contract to sell here in a couple months. And okay, so some people wonder, how is multifamily valued? Is it, and since a lot of people understand single family, in single family, the value of a property is determined by what other comparable properties are selling for. If the house down the street just sold for $200,000 and it's similar to a house that I'm trying to sell, then I can expect, near that. With multifamily, it's not exactly like that. With multifamily, you are buying or investing in a business. And what you're doing is you are buying a cash flow system. So in single family, we're really limited to what we could do to increase the value. With multifamily, we have some extra options to force the appreciation, to force that value up. We don't have to worry so much about what other properties are going for. Yes, we consider cap rate, but we can kind of have more control over it when we force the appreciation. Okay, what do I mean by that? Okay, so when we buy a property, we look for a value add opportunity. Maybe it's being mismanaged. Maybe the rents are lower than they should be. Maybe the property is looking really tired, and so it's attracting, lower paying rent and things like that. We're negotiating right now on a 338 unit. It's owned by a guy that's owned it for 15, 18 years. He's getting up in age, and we see that we can implement our own management and instantly raise the value of that property, because we can go in there, manage better, increase the rents, improve the property, and then now we've all of a sudden added a lot of value to the property. When you have multiple properties in an area, we've got the economies of scale, and we get better pricing through insurance, through management, through maintenance, vendors, things like that. So anything we do to the net operating income is then sold on a multiple. So at a 5 cap, you're getting 5% of your property value back each year in profitability. That equates to like a 20 times multiple. So the property is being sold on a 20 times multiple at a 5 cap. So if we're able to raise the rents on this hypothetical property, $1 million property, it's being sold at so it's a 5 cap. It's bringing $100,000 a year, so it's a $2 million property. Would give us $100,000 a year. If we increase the net operating income by $20,000, then on a 5 cap, 20x multiple, that would give us an extra $400,000 of value that we just created by increasing the income or decreasing the expenses. So that's really how we force our own appreciation and kind of control the destiny. So when, let's say we, so anyway, hopefully this isn't getting too deep into the weeds here and getting confusing, but really with multifamily, I think there's more certainty than we have in some other ways than other asset classes, because we can kind of force the appreciation. We look at a property going in and we think, okay, we apply our management instead of using this. The owner is self-managing. Well, we can instantly cut down expenses and we can increase the income, increase the rents and whatnot. So let me give you a case study. Let me share my screen here again. Okay. There's our contact info if you want to take a picture of that. Okay, so here's a case study. I guess my slide's a little messed up. Okay, so here's the property that we purchased in Birmingham, Alabama. We bought it 2 years ago, January of 2019, $4.5 million. We raised $2 million from investors to acquire the property. We got a $2 million renovation loan as part of the loan. So essentially, it cost us $6.5 million to acquire this. There's the before pictures. It had 27 units that were downed. And then here's what it looks like today. We've been able to increase the rents, decrease the expenses, and through that renovation loan, we, raised the value of the entire property. So we raised $2 million to acquire the property. We've got $8.5 million into it, and now the property is worth $10.5 million. Since we raised $2 million and we created $2 million, we essentially have doubled our equity in the property in just 2 years. And that's just kind of a simple case study of, kind of how we operate. Okay, so who to invest with? I know there's a lot of people that you run into that maybe have an opportunity that they'd like you to look at. I'll just give you a few little tidbits that you can consider. You want to invest with people who are experienced, not just doing their first deal, not experimenting with your money, but they know what they're doing. They know the market. They're in the market. They've been in real estate for a long time. You want to invest with people who operate with integrity and with values. What's more important than the actual investment itself is the people that you are investing with. The asset that you're investing in almost needs to come secondary to, to the people that you're investing with. So that's the main thing. Invest with people that are operating with integrity and values. And then next, you want to invest with somebody that has aligned interest, who is incentivized to deliver the highest return. And that's one thing that we like to do at MultifamilyGeeks. We generally pay a preferred return. And then after the investor is made whole, after they've gotten their preferred return, a set amount of interest or a set amount of profit on their investment, then comes the profit split. And then lastly, you want to invest with somebody who's not speculating. In any time, but especially in a time of uncertainty, you want to invest with multiple exit strategies. If we get stuck with this for a long time, are we still okay? And if the answer is that you still get an acceptable return, even if things don't work out, then then you'll be in a much better position than only having one exit strategy that could get kind of blown up. So anyway, that's what I have. I wanted to be helpful. I wanted to hopefully explain kind of a confusing subject. Forgive me if you're more confused now, but that's what I've got. And Haley, I guess back to you, or if they have any questions, I'll do my best to answer them.
Yeah, definitely. We do have a few questions here from our attendees. Let's see. And these are in the chat as well, if you would like to kind of like read along with them. Oh, where'd my chat go? Give me 1 second. Okay. Okay, that's weird. All right, here we go. Sorry, too many windows open on my computer right now. Robert wants to know, on many multifamily deal pitches, I see exit cap rates go up, but I keep hearing with more investment money on the sidelines, looking for multifamily cap rates will go down. Should we be wary of deal pitches with increased cap rates?
No, that's actually a good thing to see the increased cap rate. So, um, so let's say that you're buying a property. Okay, let's just say hypothetically that the area you're looking at investing in is a 5 cap currently. So properties in the area are trading on, they're being bought and sold based on 5% profit on the purchase price. So when you calculate, you always want to calculate a higher exit cap than when you buy it. Because when you figure a higher exit cap, you're assuming that people are going to want a better return, that things are going to be worse in the future. So when you figure on a higher exit cap, that's actually a good sign. That's, I don't know if that, Haley, is that a clear answer? Does that make sense, or do I need to go into that some more?
Yeah, I think it makes sense. Robert or anyone else out there, if that triggers another question, just send it to us in the chat and we'll get it answered here.
Let me add some more to that. Okay.
Yeah.
So the lower the cap rate, the lower the return. So you're assuming when you figure a higher cap rate at sale, you're actually figuring that people are going to require a higher return. So if it's a good deal at if a property you're looking at buying is a good deal at a 5 cap, then it's a much better deal at a 6 cap. Now you might get lucky, you might buy it at a 5 cap and sell it at a 4 cap, or you might get lucky and buy it at a 6 cap and sell it for a 5 cap. So going from so for you to have a property that's kicking off, say, $60,000 a year in profit, in net operating income, then that at a 6 cap, that's a $1 million property. So let's say that you're assuming that later on you're going to sell for a higher cap, a 7 cap, but the cap rates keep going down, and you sell it for a 5 cap. So a 5 cap would mean, let me do point times multiple. What did we say it was bringing in? Okay, I need my calculator. So what did we say it was bringing in? 60,000 a year profit. Hold on, I need my calculator. Sorry, folks. Okay, 60,000 divided by 0.05. So that's 1,200,000. So that's a good thing to assume that you're going to sell for a higher cap rate than you bought it.
Mm-hmm. Nice answer there. May or may not know this one, but how will interest rates, or how will changes in interest rates affect cap rates? Do you have any insight for us there? Might be a tough one.
Yeah, so I would say if interest rates are rising, then you have to pay a higher cap rate to get the same return. So let's say that interest rates go up 1%, then you're probably going to want to buy your properties at almost a 1% cap rate higher. And without getting too confusing, maybe the number is that you're willing to pay maybe a half cap, you need to get an extra half cap for every percent of interest rates or something like that. But as interest rates go up, you have to get a higher cap. You have to buy things at a higher cap rate to get the same return.
Awesome. And just to kind of piggyback off of that, we have another question here, and just kind of for clarification. So if you are selling it at a higher cap rate, does that mean your property value is lower?
Yes. So the higher the cap rate, the lower the sale price for the same amount of income. So, if you buy something at a 10 cap, it means that you're getting 10% profit on the property before debt payments. So if you sold it at a 5 cap, now if If you buy it at a 10 cap and you turned around and sold it for a 5 cap, you just doubled your money.
Mm-hmm. Nice.
So.
Perfect. And we have a good question from Robert here. Robert wants to know, do you expect cap rates to stay the same, increase, or decrease in the future?
So on our underwriting, we always assume that cap rates are going to increase. So we have to be more aggressive about making sure we if we think cap rates are going to go up. So whenever we do our underwriting, let's say that we're buying out a property at a 6 cap and we're planning to hold it for 5 years, then we assume that we're going to sell it for a 7 cap. So we always have to assume that cap rates are going to be higher in the future. And that'll give us the most conservative underwriting. We may get lucky, cap rates go down, we're able to sell it for more. But it's hard to speculate where they're going to go. We always assume in our underwriting that they're going to go up. But interest rates, there's some noise that they may be on the rise. If interest rates rise, cap rates will rise some.
Awesome. Great information there. We do have another question here, not related to cap rates at all, but how do you feel about regional banks and working with regional banks?
So regional banks can be really good for the smaller properties, but a lot of times you'll get your best financing through for a large loan through like Fannie or Freddie. So regional banks can really they'll do some deals that some of the bigger banks won't do because they know the market. So I recommend, especially if you're doing smaller deals, single family duplex, 5, 10, 20, 30, 40 unit, maybe up to 50 units, that regional bank is probably going to be your best way to go.
Interesting. Nice answer there. We do have another good question here. So for Class A, B, and C properties in the same area, are there any big differences in the cap rates?
That's a good question. I meant to say something about that. So, so the better the property or the better the area, the lower the cap rate. Essentially, you are taking less of a return so that you can have a nicer, more stable property. And so a lot of times people just look at the cap rate. Oh, well, here's a property for an 8 cap. But if it's in a dangerous area where you can't hire a property manager because they're all afraid to go into that area, and people are setting fires to the apartment building every week, this fantastic 8 cap that you're getting, you're probably getting a worse return than you would be getting for the others. So yeah, let's say that if a B class property is selling for a 5 cap, then an A property, which is generally 10 years old or newer, B is generally 10 to 20 years old, C is older than that, and then there's the D properties, which are just dangerous area properties. But yeah, with each different property, it'll be the better the property, the lower the cap. The worse the property, the higher the cap.
That's awesome. Good information. So I think we have just one more question here. This is a good one. How do you determine the market cap rate of an area?
So there's a couple of ways. I mean, one, if you're in the market a lot. So we focus, even though I live near Austin, we focus on a 4-hour drive of Atlanta. So like we know the cap rates there, and I don't have to check in with anybody. If you're going into a new area or you're looking, you're wanting to get started into this, then you can call a broker, and you can go to some of the different big commercial broker websites, Marcus Millichap, CBRE, ARA, Newmark, the Multifamily Group. I could list a bunch more, and you can just look at some of the properties they have. They'll have you sign a confidentiality agreement. And then you can call up the broker and just say, hey, what are B properties going for? in Bryan College Station or, wherever you're looking. So that's the easy way. Call a broker. What's the cap rate for this?
Mm-hmm. Awesome. Good info. So I think that's actually all of the questions that we have. I know this definitely helped to clear things up for me a little bit when it comes to cap rates. But Paul, before we sign off for the day, do you have any last kind of closing thoughts or final words of advice for our attendees as they may be, moving forward into their investments this year?
Yeah, sure. So like for anybody that's, okay, cap rates, if you're confused on it, I know it can be like sometimes hard to wrap your head around. You're welcome to email or call. I'll be happy to talk more about cap rates and maybe explain it better than I did today. But like if you're wanting to get into apartment complexes or really whatever you're wanting to get into, instead of trying to do that all by yourself and trying to buy a large apartment complex all by yourself, I would say find a group that you like and you trust and you feel like they have your best interests in mind, and maybe look at what they do, maybe invest with them passively until you can get to the point to where you're ready to do that on your own. So instead of trying to make all the mistakes all by yourself, tag along with a group, get on somebody else's coattails, learn what they do, and then you can, if you're happy with the results, keep investing passively with them. Or if you want to take it a step further, then you can, once you've observed some mistakes and answered a lot of your questions, then you can go into being the key principal, the general partner. So
Yes, great information there. It's always great to have a network, rely on people, use professionals, and be sure to join us at our next virtual happy hour next Wednesday, January 20th. We get a lot of multifamily investors. We get a lot of no investors. We get people from all across the US. So such a great kind of point there to leave us for today's webinar. But Paul, before we sign off, what is your contact information? Just one more time, I'm going to have Sarah put it in the chat for our attendees. Guys, if you have more questions, be sure to reach out to Quest, reach out to Multifamily Geeks. We've all got a lot of great resources for you guys. There is Paul's contact info right there, paul@hcshomes.com. And that's all I have for you guys today. I hope y'all enjoyed today's class. Paul, thank you so much for joining us today. I'm sure we'll hopefully see you soon at another event, hopefully in person sometime soon. But that's all I have for you guys. Y'all have a great day. Be sure to join us for our other events. And I will see you this Saturday at our Self-Directed IRA Saturday webinar, 12 p.m. Central Time with Mr. Fred Moskowitz. So that's all we got. Y'all have a great day.
Thanks, Haley. Thanks, Juan. Thanks, everybody else. Y'all have a good day.
Awesome, Paul. See you later.